So one of the nation's largest new home builders just announced that they had a 68% cancellation rate in the fourth quarter of last year. That certainly is problematic for the housing industry. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 16th of January. The month is pretty much half over. Hope everyone's doing well. Randy Patrick here, putting the realism back in real estate. Today is kind of a holiday. I think banks and some government offices are off for MLK Day. So if for those of you that celebrate that, please enjoy the day. I know the lenders are not working today, so all of our short sales are just kind of in limbo till we hear about them tomorrow. So just going down the path here with respect to housing, this video is brought to you by our friends at Foreclosure.com. So if you want more information and want to check out the distressed property listings that are in your backyard, your neck of the woods, go to gethousingdata.com. That's gethousingdata.com. That's my affiliate link. You can go there. You can see what? You can see foreclosures, shadow inventory, short sales, pre-foreclosures, tax liens, tax deeds, the whole bit. So again, a lot of the stuff that we've talked about over the past couple of years and things that are actually happening right now, you can find all that data and all the good stuff that's going to be discounted in your area from gethousingdata.com. All right, guys. So interesting enough here, the Fed's ongoing market reset sees buyer cancellation rate at one of the nation's largest home builders spike to 68%. That's pretty significant. That's not 10, 20%. That's 68%. And again, going back to the Federal Reserve's Chairman Jerome Powell, who back in June said that they basically would raise rates to cause a housing reset, and that the U.S. housing market would slip into a difficult correction. Well, I think what he said is really coming true, and we'll see how this all plays out. So it's KB Home, one of the nation's largest publicly traded home builders. Wednesday, they announced that its buyer cancellation rate in the fourth quarter of 2022 spiked to 68%. That's up 35% from the third quarter of 2022 and up 13% in the fourth quarter of 2021. So you can see the trend here that obviously as mortgage rates are going up, price points really haven't come back down to earth yet in the new home building segment. So people are going, you know what? We're not going to buy. We're not going to roll the dice. We're not going to overpay for a property. We're not going to be in a situation where we get caught. So they're just canceling their contracts. So basically, as they said, we prioritize delivering our large backlog and protecting our high margins over taking steps to stimulate additional sales during the seasonally slower time frame. But again, what can they actually do? I mean, they're going to offer incentives to get people to purchase, but again, cancellation rates are huge. And, I guess people are probably walking away from deposits as well, too. That's maybe a little bit of, saving grace for some of these builders, but it doesn't make up the cost of a new house, of course. So again, really chaotic in the new home sector. KB Home, one of the nation's largest home builders. Again, if you take a look at the cancellation rates, you can see, where it was headed. So obviously, over a 40% cancellation rate during the COVID recession, and now obviously with mortgage rate shock, you can see that cancellation rate is skyrocketing. It's kind of increasing exponentially. So will this continue into this first quarter of 2023? Well, if rates continue, and also we have, this is the time frame where not much happens in new home construction in various parts of the country, like Midwest and the Northeast, because of the weather. So this could cause further delays in new sales, and maybe there would be more cancellations as well, too. We can't we can't write off the fact that inflation, cost of living, all those things, recessionary items have played a part in people sort of saying, you know what, now is not the right time for me to basically jump into the largest purchase I'll probably make in my entire life. So there you go. Next slide here, let's check it out. So as I said, a lot of stuff's happening. This is just KB Home. So really, historically speaking, a 68% cancellation rate is off the charts. Even during the darkest days of the 2008 era crash, the average builder cancellation rate reached only 47%. So yeah, that was the average builder back, guess what, how many years ago? We're talking 14, 15 years ago, right? What's going on? Obviously, pressurized affordability, having a 40% increase in U.S. home prices and a shock wave. Also, we're looking at basically 6% plus mortgage rates now. Spiking cancellation rates have put home builders in a pickle. Basically, the problem, builders have a tremendous amount of inventory, both single-family and multifamily in the pipeline. The pandemic housing boom coupled with supply chain issues pushed the number of U.S. housing units under construction to a record high in 2022. So for those of you who are saying, but we don't have inventory, well, there's actually inventory there. It's whether you can afford the inventory or want to pay for that inventory. So it's there. I mean, it's just if you want to jump in that area. Now, obviously, as I said, they're going to have to continue to their housing downturn playbook to unwind that unsold inventory. They're going to obviously offer incentives. And one of the things that we talked about last video is these what we call mortgage buy downs. So they're going to start doing incentives like that. So basically what we're seeing is that if you do a mortgage buy down and offer incentives, that actually works for the builder, and the reason being because they're protecting the comparables. That's interesting. That reason, coupled with wanting to protect their comps, is why builders prefer to offer incentives like mortgage rate buy downs rather than to cut prices too much. So that's the whole thing. Yeah, they're going to offer you upgrades, mortgage buy downs, and your financing. Who know? And we know that they're offering real estate agents, increased commission or bonuses to bring people and get sales moving as well in the new home construction arena. But this is the thing. If you do the buy down, you're actually working a little more affordable mortgage payment, but you're not reducing price on the property. So again, it's kind of I won't call it sneaky, but obviously smart from their end, because what they don't want to do is lower their prices and then cause some chaos within their own sort of environment, their own subdivisions, etc. So by keeping prices where they're at and offering these incentives, maybe they're hoping to make up the difference win payments or just whatever, just offering more for people to get them in the door. So you don't feel like you're overpaying for the product you're going to get. Well, which is very interesting. But again, I like how they're protecting comps. That's maintaining the status quo. Now, clearly, even though the Fed's in a reset market, which has sent the builders reeling from what they're saying here, it's hardly a doomsday for them. Just look at the stock market. So you can see basically that, Horton, Lennar, Toll Brothers, NVR, Pulte Group, KB Home, they're all doing okay. They dropped, obviously, during COVID. They spiked back up. They've dropped a little bit now. They kind of leveled off. It looks like KB Home is the only one that really is suffering a bit more. And, that could be for a lot of reasons. That could be based on house mix, price mix. It could also be based on where, their inventory is at. Are they more West Coast based where things are more expensive? So things like that. While major home builders are all down from their 2022 highs, they're still well above January 2020 share price. That includes builders like D.R. Horton, up 78% since Jan 1 of 2020, Lennar 73%, Toll Brothers 34.5%, NVR 29%, Pulte 25%, KB Home only 1%. So they seem to be the group that has taken the most hit. Basically, B of A, Bank of America researchers think the bottom in home builder stocks could be in the rearview mirror. Basically, Bank of America reiterates that a neutral rating for KB Home. So yeah, we know that. Guess what? We're going to see some price reductions on existing homes, which would probably drag down some new home pricing. We're going to see the mortgage rates maintain. Again, the last video, the Fed's not budging as much as a lot of people are saying they believe we'll start to see some rate cutting in 2023. As we said before, that wasn't really on the horizon for the Federal Reserve. So unless something dramatically changes with the economy, recession, whatever, don't expect any rate cuts coming down anytime soon. So essentially, this is what's going to happen to the home builders. They're actually going to, they're going to suffer before that gets a lot better. Sorry, a little better for the builders. There you go. It's been a while since I've done a video, guys. A little tongue-tied today and very, very busy. So anyway, for those of you who appreciate the information I provide, if you could hit that subscribe button, help my channel grow, thank you very much. And those of you who are already subscribers or think you are, please resubscribe, hit that subscribe button. I've lost about 200 subscribers over the past week, believe it or not. So things change all the time in YouTube world. So thanks, guys. Appreciate it. Oh, by the way, sorry, let me go back here. What goes on in 2023? So I talk about this quite a bit. If you're in the Tampa Bay area, I'm going to start doing more and more monthly meetings for our real estate club that I'm involved with. And I talk about, obviously, this stuff in detail with respect to what's happening in the housing market, the correction, the crash, the crisis, and the opportunities that are out there. So in what's going to happen going forward now, and we've had it for the past 6 months for sure, but going forward, it's going to pick up a lot more with distressed properties. Here's what you have to look forward to. More foreclosure auctions, more bank-owned, real estate-owned, bank-owned REO properties becoming available. Potentially more short sales that are out there. Also what's called short payoff opportunities. Those I can get into in some of our training. It's taking the property subject to the mortgage. It's not in a mortgage assumption. You're taking over the payments, but still controlling the deal, and you're actually taking the deed, believe it or not. HOA, COA, that's homeowner association and condo association foreclosures. That will be picking up. Why? Because when we're in situations where we have, tough economy, people losing jobs, people, again, recession, inflation, the whole bit, something has to give in your normal payment cycle of your life, right? We're seeing a lot more probate estate foreclosures now, great opportunities there. And also what happens when you have things like tax deeds and foreclosures that go on, there's something called like surplus or overage, okay? And that's a whole other niche market. Basically, if the foreclosure auction yields more at auction than the final payoff or what's called the final judgment, then the surplus or the overage is actually entitled to the homeowner, believe it or not. But there's no sort of method to getting that money to the homeowner, so that's an opportunity where you can actually work, find the homeowner or previous homeowner or heirs, etc., look them up, and you work a deal saying, hey, I know how to get my hands on that surplus money for you if you obviously share the proceeds with me. So again, these are some great opportunities, and it's going to be good 2, 3, 4 years of this for sure. Now, for my business, right, I want to make sure that people know now that I've been growing over the past 6 months. As you know, I've been obviously talking in the videos for advertising for opportunities and for agents and whatever. So I'm basically open for business. What I mean by that is we're open, if you want to come in our area and want to talk about new construction, I've got real estate agents, good ones that understand the business. We all drive for value and to drive for the lowest price possible for you as a buyer. New home construction, we're great at that. Existing properties in MLS too, again, placing offers, driving for the best price for you. Investment opportunities, cash flowing opportunities, Airbnb opportunities, fix and flip opportunities. Obviously connect with me for those. Single family residential, multifamily, we work both ends. I do have some supply chain with multifamily across the country, so if that's interesting to you, you've got always stuff going on there. Build to rent, build to flip. So basically, I have construction groups, contractors, developers who can assist with that and actually provide these provide the work for the projects, which is great. And also with all this, I have a huge connection with finance. What I mean by that is investment product type loans, financing, lenders, hard money, whatever. So we're set up here to handle anybody that comes through our sphere and work with them from a real estate perspective. So, and again, as I say, I'm always looking to grow, looking to add. So again, if you want to move forward with a few things, want to have a discussion, just reach out to me. Obviously, I'm launching my new program, my new Foreclosure Fortune program, pre-sales discount. Foreclosures will be big this year. And as I mentioned, though, we're also doing the normal stuff in real estate, which is just helping people buy and sell property. So if you want to reach out to me, that is my email. Just connect with me, send me your telephone information so I can get a hold of you, and we'll go from there. So once again, I appreciate the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And look forward to speaking with you later on this week. Talk to you later.